Hey everyone, it's Simon here. Just thought I'd make a quick video as a follow-up to the video I published on the 16th of January. So back on the 16th of January, which was this candle here, I made a video explaining why I thought we would get a breakout of this downtrend line and the 200-day moving average rather than a rejection. That ended up happening, albeit in a fairly squirrely manner. We had a fairly sharp 2-day pullback before the breakout became real. There's one thing I've learned about in markets. Markets will often do the expected or the obvious, but they will nearly always do it in an unexpected or unobvious way. Of course, I got a lot of people asking me on this day whether my view still held, and really my view was so long as these lows here held, I was very happy to give the market the benefit of the risk to the upside. Now, as we head into this week is obviously Fed week. We got the FOMC rate decision and Powell's press conference on Wednesday. That's Wednesday, the 1st of February, and absent the FOMC meeting, I would say markets here really look primed to rise. If we look at the S&P 500 here, we've got rainbow logic. The key moving averages I look at are aligned in a bullish manner. If we pull out to a weekly chart, and I'll just zoom out a little bit here, but what we've got is a fairly classic kind of bottoming pattern, and the absolute bottom here coincided with the 50% retracement from the COVID crash low to the all-time high and the 200-week moving average. The ATMA is crossing back above the 21. We've got the breakout of obviously this downtrend line. It's all looking good for what could be a reasonably solid bottom, as in a lasting bottom. But the fact is, Powell could pour cold water over this if he chooses. Now, either Powell will bless the recent market action or he won't. But you can see the S&P, it's getting near a very key battleground. Looking at 410 on SPY, that's 4100 on the cash index. It's kind of almost there, okay? And this was always going to be the next battleground. There are a few other markets that I follow that are at key pivotal areas as well. If we look at, for example, the dollar, which has been a very important market to analyze over the last year or so. So you can see the dollar peaked here back in December. The stock market bottomed in October. So the bottom of the stock market didn't coincide precisely with the top in the dollar, but they were within a few weeks of each other. And really, since the dollar peaked, the market has been more sideways, and obviously we've had a decent rally in January. A rising dollar is a headwind to risky assets like stocks and the stock market. A falling dollar is a tailwind. Now, the dollar is getting back to an area of support. See that previous swing low there? Also coincides with a Fibonacci retracement level from this major low here. There's no question the dollar is looking oversold short term, but things can look oversold for long periods of time when you've got a really strong trend. And I suspect on Wednesday, we're going to get a candle that looks either something like that or something like that. I think that we'll get a big move up or a big move down, depending on what Powell says about the future of the price of money. If the dollar does find support around here and start heading back up, you can expect that will put downward pressure on stocks. Let's have a quick look at the bonds. We'll just check out the long bond, the 30-year bond futures. And you can see that they are at a fairly pivotal area as well. We had like a little double bottom here. We're now looking at potentially a double top. Ordinarily, I would look at that sort of chart and think, well, bonds are probably due to roll over, and that's going to be all sorts of trouble for, in particular, tech stocks and the NASDAQ. But again, it all depends on what Powell has to say. And if bonds continue to rally here and yields continue to fall, that's going to be very good news for tech specifically and the NASDAQ in general. Let's check in with the VIX here quickly as well. So the VIX is trading at support. All right, it's been trading down around sort of the low 18s. This has been a very strong support level. And if you look only at the VIX, a VIX at these levels has generally been a pretty good sell signal, certainly over the last year. Now, VIX has really been very sideways over the last week or two. And again, I think it's in anticipation of Fed Day. And if the market loves what Powell has to say, you could expect the VIX to actually trade lower and sort of trade like a teenager again. Of course, if the market hates what Powell has to say, the VIX will more than likely use this as an area of support once again and spike higher, which will mean the S&P is heading lower. Things like the FOMC meeting, rate decision, CPI, to a lesser extent the jobs number, they've all become binary risk events. And that's why my plan is to get back to flat or very close to it in anticipation of FOMC, and then study the market's reaction and look to build some new positions once we've got that information to hand. I don't like trying to front run the Fed. There are plenty of people convinced that the Fed are going to raise 50 and give a very hawkish commentary and markets are going to roll over and die here. And there are just as many who are pretty sure that inflation's under control. They'll raise 25 and take a very softly data-driven approach from here. But I can tell you, I've got no edge in guessing what Jerome Powell is going to say on Wednesday. And if you think you do, you may just be tricking yourself. Okay, so the technicals here look pretty good on the whole. The internals look good too. Here's a measure of breadth, the advanced decline line. What we're seeing here is the advanced decline line has exploded to new highs. The S&P, when you cycle highs, the S&P hasn't done that yet. But there's a good indication here that it will do so. And that even if Powell does pour cold water on the market rally, we may just be looking at a garden variety pullback rather than something much more serious. But look, we'll know more after the Fed meeting. I'm treading very, very lightly in anticipation or in the lead up to FOMC, and I will be looking to add some new positions and put on some more risk post the FOMC. That's a wrap for today. I hope it helps, and I'll catch you next time. Thank you.